Hey, good morning, options traders. Well, here's another good question for the group. Can you turn a bull spread into a bear spread? I get questions a lot like this from traders asking about various morphs or just different ways to scale in and out of positions. And so when we're in markets like this and we're going through a lot of whipsaws, questions come up about how do I turn a position from bullish to bearish or vice versa. And we can really do it with any type of strategy, but I'm going to also show you a nice little trick you can do to figure this stuff out on your own. So how can you turn a bull spread into a bear spread? Well, let's start with an initial trade. Let's say that you buy the 100 call and sell the 105 call. And we'll just throw a number out there and say that you executed this for a net debit of 2. So for the new traders in the group, what this means is that we have a trade that you had to buy, had to spend money, and you had another trade here that you sold where you received money. So on a net basis, did you have money going out? That would be a net debit. Or did you have money coming in, which would be a net credit? So here, let's just say it was a net debit of 2. So this is a long 100, 105 vertical spread. That's what we're looking at right there. And this would be the risk graph. So as I always like to point out, here is a bend at our long 100 strike. Here is another bend at the short 105. And because we've spent 2, that would be the maximum loss. And this is a $5 spread. That's the difference in those strikes. And so the most this spread could ever be worth is 5. We have the right to pay 100 and a potential obligation to sell for 105. So that's $5. But because we spent 2, that means the maximum gain to us would be 3. So this is our bull spread. And so now let's say the stock has moved up above the short strike, and for some reason we've turned bearish. Can I flip this around? Can I make this risk graph become a bear spread? So one thing I want to show you here is how it's fairly easy to do just by jotting it down on paper. Don't try to memorize all of the various morphs. Instead, just understand what are the steps I need to do to figure it out. So in this example, you're long the 100, 105 vertical spread. So let's say that we want to change this to the 105, 110. All right, so this is our starting point, and I'm trying to get to a short 105, 110. Well, what would I need to do? First thing is, I've already got the short 105 call in the account, but I need to get rid of this 100 call. So one part of my trade is to sell the 100 call. And when I do that, these two positions will cancel. And that's just going to leave me this short 105 call. What else do I need? Well, I need the other leg of the bear spread. So if I wanted that to be a long 110, I would need to buy the 110 call. And there's your answer. I need to sell the 100, 110 vertical. And when I do, I'm going to be left with a short 105 call and a long 110, and that is a bear spread. So here was the short $100 call, and we bought the 110. That's the trade that we just executed. And let's just say that it's a credit of $7.50 that we get. When I ran it in the pricing model under certain assumptions, this was the credit, so I'm just going to use that for the number. But just intuitively, remember that we were assuming that the stock was above the 105 strike on our original vertical. And so the $100 call is deeper in the money. And it's certainly going to be more valuable than the 110. So we know this is going to be a credit, and a fairly healthy one. And so when we put these trades in separately, this is what they would look like. In blue is the original 100, 105 bull spread. And this one that we just placed is the short 100, 110. And there's our credit of $7.50. So if we look at our risk graph, here's 0. And there's our $7.50 credit. And because this is a $10 spread, there's a $2.50 potential loss over here. But remember, this wasn't the only trade that we placed. We also had this trade in blue that we have to account for. We assume that was a debit of 2. So what's the net between these? Credit of $7.50, debit of 2. That would be a net credit of $5.50. But we now have a $5 spread. It's a credit spread, so it's a $5 liability for which we got paid $5.50. So if anybody offers you $5.50 to face a maximum $5 loss, don't turn it down. And that's one of the things that we're doing here. We are locking in a 50-cent gain. We now have turned bearish, and we might make a lot more than we had potentially set out for with the bull spread. So once both of these trades are executed, this is the net position. So notice here is our short 105 call. There's the long 110. Right here you can see the entire curve is shifted above zero. So there's our guaranteed 50-cent return. And because this is a $5 spread, maximum could actually be $5.50. $5 from the spread plus the 50-cent net credit over here. So we can't lose, but we might make a lot more, and certainly a lot more than the $3 we set out for with the bull spread. So that's really just the basics of it. The main thing I just was trying to show you is how you could step through and figure out what trade do I need to place to put myself into a new position. Jot down your starting position, what you have now. Jot down the position where you want to go, and then just start crossing things out. What do I need to cancel? What do I need to add? And figure out what that trade is. And after a while, you'll get good at that, and you can start doing these in your head. But for anybody who wanted to know how to turn a bull spread into a bear spread, this is how you do it. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.